On the 27th of March 2026, the government sent a formal letter to the House of Lords. The message was simple: we are not changing the deadline. The House of Lords Economic Affairs Committee had spent months examining the new pension inheritance tax rules arriving in April 2027. They called expert witnesses. They took evidence from pension administrators, legal professionals, and bereaved families. And their conclusion, published in January 2026, was precise and unambiguous. The 6-month deadline for paying inheritance tax on pension assets is, in their own words, not realistic. The government's response, dated the 27th of March 2026, was equally precise. The existing long-standing deadlines ensure tax is collected quickly and efficiently. We do not intend to change them. Before you decide whether this matters to you, there are two things worth saying directly. If the person whose estate your family will one day have to administer has a pension they have not fully drawn down, this decision affects your family, not a distant hypothetical family, yours. And if you are the person who holds an unused pension pot and you have children or grandchildren who will one day be responsible for your estate, what the government refused to change on the 27th of March 2026 will fall on them. Stay with me for the next 20 minutes, because the combination of the April 2027 rule change, the 6-month payment deadline, the interest rate that kicks in when that deadline is missed, and the administrative complexity that the Lords described as significant delays and costs for bereaved families, all of it is now locked in. Understanding exactly what that means in practice is not optional for anyone planning retirement or managing a family estate. If this channel covering what is genuinely happening in UK pension and inheritance tax law is useful to you, subscribe now. That is the only way the next update finds you before the deadline matters. To understand why the Lord's recommendation was so important and why the government's refusal to accept it matters so much, you need to understand the specific administrative problem that the deadline creates. From the 6th of April 2027, when someone dies with money still in an unused defined contribution pension, the SIPP, a personal pension, a workplace DC scheme, the value of that pension is included in their estate for inheritance tax purposes. The person responsible for dealing with that tax is the personal representative. That is the executor named in the will, or if there is no will, the person appointed by the court to administer the estate. In most families, that is not a professional. It is a son, a daughter, a spouse. Someone already dealing with grief, with funeral arrangements, with the paperwork that arrives in the weeks after a death. Under inheritance tax rules that have existed for decades, that personal representative has 6 months from the end of the month of death to pay any inheritance tax owed. After those 6 months, interest begins to accrue on the outstanding balance. The current late payment interest rate is 7.75%, confirmed as the applicable rate in April 2025, set at 4 percentage points above the Bank of England base rate. Under the existing system, before April 2027, the personal representative deals with assets they have legal access to. The house, the savings account, the investments. They can sell assets, draw on funds, move money. The 6-month deadline is tight, but it is workable for most estates. From April 2027, the estate includes a pension pot that the personal representative does not legally own, cannot directly access, and which sits inside a pension scheme that has its own administrative process for dealing with deaths. And that process does not always move in 6 months. Here is the specific chain of events the House of Lords described in their January 2026 report, and why they called it not realistic. When someone dies with an unused pension, the personal representative must first identify which pension schemes the deceased was a member of. They may know about some. They may not know about all of them. Pensions accumulated over a 40-year working life can sit with multiple providers. Old workplace pensions from employers decades ago. Personal pensions opened and then largely forgotten. The government rejected the House of Lords' recommendation that personal representatives should be granted access to the pensions dashboard, the government's own digital service that consolidates pension information to help identify all schemes. So personal representatives must find them the way estates have always been found, by going through the deceased's papers, by asking family members, by contacting former employers, by writing to providers and waiting. Once a pension scheme is identified, the personal representative notifies it of the death. The scheme then has a specific period to respond with evaluation of the pension assets at the date of death and information about the nominated beneficiaries. Under the draft regulations published by HMRC in May 2026 for technical consultation, pension scheme administrators will have 28 days from notification to provide that information. But notification itself can take weeks from the date of death, particularly if schemes are not immediately identified. And 28 days from notification, added to the weeks spent finding the scheme in the first place, takes the personal representative deep into the 6-month window before they even have all the information they need to calculate the inheritance tax owed. Once they have the valuation, they submit the inheritance tax account to HMRC. They then arrange payment. The payment can come from estate funds, from the pension scheme itself if a withholding notice is used, or from a combination of both. A withholding notice allows the personal representative to instruct the pension scheme to hold back up to 50% of the benefit for up to 15 months to ensure funds are available to settle the tax before the rest is paid to the beneficiaries. That mechanism was a change the government introduced in response to industry pressure. It is a genuine improvement. But as the House of Lords report noted in January 2026, it does not resolve the underlying timing problem. The pension scheme must still be found. It must still be notified. It must still provide valuations. The tax must still be calculated and paid, and the 6-month clock runs from the end of the month of death. For an estate involving multiple pension schemes, some of which were not immediately identified, with a personal representative who has no professional experience of probate, who is simultaneously dealing with their own grief and the rest of the estate's administration, the 6-month window is, in the Lord's own assessment, not realistic. The government's formal response, published on the 27th of March 2026, rejected 18 of the committee's recommendations. The rejection of the deadline extension was the most significant. The government's stated position was that the existing 6-month deadline is long-standing, ensures tax is collected quickly and efficiently, and is consistent with how other estate assets are already treated. The Exchequer Secretary to the Treasury, Dan Tomlinson, confirmed in correspondence with the Lords that no change to the deadline was intended. The government also rejected the committee's recommendation for a statutory safe harbor, a formal legal protection that would shield personal representatives from late payment interest, where they could demonstrate they had taken every reasonable step to meet the deadline, but had been delayed by circumstances beyond their control. The government's position on the safe harbor was that existing HMRC discretion to deal with exceptional circumstances provides sufficient protection. The committee and the industry professionals who gave evidence to it did not agree. Pensions commentator Sir Steve Webb described the government's position as inhumane, saying no consideration had been given to the human dimension of this. Lord Little, chair of the Finance Bill Subcommittee, was measured but pointed in his assessment of the government's repeated failure to engage with concerns raised by stakeholders at earlier stages of the policy design. The committee's report noted that witnesses had told them concerns about the 6-month deadline were raised with the government immediately after the Autumn Budget 2024 announcement, and that the government did not appear willing to engage at that time. Let me give you a person to place all of this alongside. Margaret is 71. She has a house worth £380,000, savings of £45,000, and a defined contribution pension she has left largely untouched. She has been living on her state pension and a small annuity. She has a son, David, who is named as executor in her will. She has 3 pension arrangements. One from a large employer she worked for in the 90s, one from a smaller company she left in 2008, and her current SIPP. David knows about the SIPP. He is less certain about the others. Margaret dies in November 2027. The inheritance tax deadline falls at the end of May 2028, 6 months from the end of November. David spends the first 3 weeks locating and notifying Margaret's pension schemes. The large employer scheme notifies him that the valuation will take 4 weeks. The smaller scheme requires a grant of probate before releasing information, and probate takes 12 weeks. By the time David has all 3 pension valuations, it is mid-April 2028. He submits the inheritance tax account to HMRC. He has 6 weeks left. He has arranged payment from the estate savings. He uses the withholding notice for the SIPP to ensure the pension scheme can contribute to the tax directly. He meets the deadline, but only just. And that is a relatively straightforward case. No unexpected schemes, no contested estate, no complicating factors. The Lords described scenarios with deaths at younger ages where multiple former employers need to be traced. Multiple schemes at different stages of their administrative processes, a personal representative who is also dealing with the death of a parent, the administration of a house sale, and their own full-time employment. The committee's conclusion that many personal representatives will face late payment interest through no fault of their own is not an exaggeration. It is an assessment based on the evidence of how estates are actually administered. There are 3 things worth doing given where this now stands. The first, and this is the one that will save your family the most trouble, is to create a simple record of every pension arrangement you hold and keep it somewhere your executor can find it, not buried in a filing cabinet, not referenced only in paperwork. Your executor will need a grant of probate to access, a clear, accessible list, the name of the provider, a policy or scheme reference number, a phone number for the scheme, whether there is a nominated beneficiary on file. That list, kept with your will or in an obvious location, is the single most practical thing you can do to shorten the identification and notification process that David faced above. HMRC's own technical note published in May 2026 explicitly recommends that pension scheme members keep an up-to-date record of all their pension arrangements to help their personal representative after their death. That recommendation exists precisely because the government knows identification is the first and most time-consuming part of the process. The second is to ensure your expression of wishes. The nomination form your pension provider holds telling them who you want to benefit from your pension is current. This does not override your will for inheritance tax purposes, but it determines who the pension scheme pays after the tax has been settled. An outdated nomination can direct money to the wrong person, create additional administrative complexity during an already difficult period, and potentially delay the final payment to your intended beneficiaries. Contact each of your pension providers and ask to update your expression of wishes. Most allow this online or by post. The third is specific to anyone likely to act as a personal representative for a family member who holds pensions. The withholding notice mechanism introduced by the government allows you to instruct the pension scheme to retain up to 50% of the pension fund for up to 15 months from the end of the month of death, to ensure money is available to settle the inheritance tax before the remainder is distributed. If you are ever in the position of administering an estate that includes an unused pension, using this mechanism as early as possible in the process gives you the greatest flexibility in meeting the 6-month payment deadline. You do not need to wait until you know the full tax liability to issue a withholding notice. Issuing it early preserves the option to use pension funds for the tax payment. Waiting until the calculation is complete may leave insufficient time before the deadline. Here is what ties all of this together. The government's decision to bring pensions into inheritance tax from April 2027 is law. The Finance Act 2026 received royal assent on the 18th of March 2026. That decision was made in October 2024. The decision to reject the 12-month deadline extension was made on the 27th of March 2026. The decision to reject the statutory safe harbor from late payment interest was made in the same response. The interest rate that kicks in when the deadline is missed, currently 7.75%, continues to accrue daily on any outstanding balance. The people who will navigate this process are not professional estate administrators in most cases. They are adult children. They are surviving spouses dealing with their own grief. They are trusted friends or neighbors named in a will written years before anyone imagined the pension would be subject to this deadline. The House of Lords was not being alarmist in January 2026 when it described the 6-month deadline as not realistic for pension assets. It was describing what it heard from the people who actually administer estates, and the government's response was not a technical disagreement about timescales. It was a decision made clearly and on record that the existing system would not change. That decision is now the environment in which every estate involving an unused pension will be administered from April 2027 onwards. Planning for it now, creating the record, updating the nominations, understanding the withholding notice, is the only thing within your control. The deadline is not. If you know someone with an unused pension pot who has adult children who will one day be responsible for their estate, a parent, a sibling, a friend approaching retirement, send this to them. Not because their situation is beyond managing, but because the gap between a personal representative who finds all the pensions within the first 3 weeks and one who discovers a scheme at month 4 is the gap between meeting the deadline and paying 7.75% interest on a bill that was always coming. One conversation now, one list created this week could spare your family months of administrative pressure at the worst possible time. Subscribe to this channel for plain English coverage of what is genuinely changing in UK pension and inheritance tax rules, the decisions being made in Parliament, the deadlines that follow, and what they mean for real families. I will see you in the next one.